I want to answer a major question on the show, which is a question I get a lot, especially lately, which is, my goodness, is now really a good time to get started in multifamily, right? We've kind of a little up and down roller coaster here with COVID. Bridge lending went away, and then, the sky was going to fall. All of a sudden it didn't, and things got even hotter than before, right? So the question really is now the right time? Now, to disappoint the audience here, the short answer, and I'll give you a longer one in a second, but the short answer is no, because it's never really the right time, is it? I mean, think back earlier in the year before COVID, right? Market's hot, red hot, right? Why don't I wait till the market cools? Well, shoot. Then COVID came around and the market cooled. And then we're like, oh no, we can't do a deal right now. We can't get a deal. We can't get loans right now. Sellers are asking too much. It can't be done right now either. Well, okay, so that's not the right time, but you asked for cooling off and that came. And now it has cooled off. Well, then all of a sudden, sometime after COVID, I don't know exactly when, people started saying the opposite again. They're like, oh my gosh, COVID, I guess, wasn't so bad, and now it's gotten too hot again. Now, is the time really ever right? And the answer to that is no, and that is lesson number one, which is there's never a perfect time to get started. That's lesson number one, okay? If you try to get it just right, the stars will never always align. There's always going to be something that's not right about the situation in your personal life, in your professional life, in your finances, in whatever. Just never a perfect time. Therefore, don't look for a perfect time because it doesn't exist. Now, lesson number two, if the fundamentals are strong, stick with the strategy and adjust the tactics. Too often I see people making knee-jerk reactions to something what's going on. I mean, even with COVID, people said, oh my gosh, I got to start investing in the country because everyone's moving to the country, right? But what if COVID then kind of normalizes and people go, oh my gosh, I really do miss walking to restaurants and I really love the theater and I'm going back to the city, right? Now, all of a sudden, I invested all this money in suburban living and it kind of swung back. So don't have knee-jerk reactions on something. Look at the fundamentals. And the fundamentals of multifamily are strong. They're amazingly strong. Not only in COVID, but also how it performed in 2008 when the entire world blew up except for multifamily, right? And so are the fundamentals strong? Do you believe in the fundamentals? And we're going to answer that question today because you might say, well, Michael, I'm not so sure if I believe in the fundamentals. But if you do believe in the fundamentals, and you can make up your mind after this show is over, then stick with the strategy and adjust your tactics. And my gosh, we've had to do a lot of adjusting of tactics after COVID. For example, bridge loans went away, the terms went away, loan to value went down. You couldn't finance construction anymore. You had to put 9 to 12 months of money in escrow. Well, we modified our underwriting. And we did 2 deals, in last year in COVID, and we did so by adjusting our underwriting, but we did not adjust our strategy in that sense. Now, let's answer the question: is the market too hot? I mean, clearly, we've had a major run-up in prices, and we've had that run-up since, 2012, 11, ever since the last recession recovered, and it seems like we're in a bubble. The question is, are we in a bubble? And, the definition of a bubble is basically there's an environment where speculators are making money hand over fist. In a bubble, the fundamentals are out the window. We saw several bubbles. We saw it in the late 1990s with the dot-com boom and bust. Companies were trading at, no one could actually gauge the value of a company. Then we saw it again in 2005 in the run-up of real estate where you could buy a house and sell it, for $20,000 more 3 weeks later. You haven't done anything at all. That is speculation, my friends. That's where the fundamentals are out the window and you don't even know what's going on anymore. Now, the question is, are we in a speculative market? And I don't think we are. But let me make the case and you make up your own mind. There's really 3 reasons why prices are going up. Okay, 3 things. One is we've had low interest rates, and just when we thought they couldn't get any lower, they went even lower. So we have low interest rates. Well, that obviously is going to drive up prices. Then we've had increased demand, which is fueled by limited supply. So that's a factor there. And then we are in an unusually high inflationary environment, therefore also increasing rents. Okay, so let's look at each of these, not only what's happening, but what I'm seeing in my crystal ball about each of those. Let's look at interest rates right now. So if you parse the Fed's guidance from the last, 12 months, they're talking basically, the consensus is interest rates are low. We're going to keep them low through 2022, and we may hike it up 1 or 2 times in 2023. But the bottom line is interest rates are going to stay super low, certainly for the rest of this year and the next year. That is everyone's agreement right now. So why is the Fed doing this? Why are they keeping these interest rates low? Well, they're doing it because they feel like they need to fuel the economy. Okay, they want to kind of jumpstart the economy, and it worked so great in the last recession. They're literally buying $120 billion per month in mortgage-backed securities. And this is one of the biggest factors why the interest rates, are of course so low. And we are kind of in an environment that's hard to understand, because I've been studying this a little bit. I'm like, what is interest rates, and what is it there? Obviously, the interest rates are low, then the economy it's cheaper to borrow money. Therefore, more people will borrow money and put more into the economy. At the same time, inflation, if we can fight inflation by raising the interest rates. Well, I'll talk about inflation next, but what is the outlook on interest rates maybe after 3 years? So for the next 2 years, the consensus is we ain't doing nothing. Okay, so that's great. But what about after that? And the problem really is for the Fed, if it is true that raising interest rates are there to fight rising inflation, which they acknowledge is at this point transitory, not permanent, therefore I don't need to fix anything because it ain't broke. Therefore, I'm not touching interest rates. But even if they were to try to increase the interest rates, they have a major problem. For the first time ever, we are above 28 trillion in U.S. debt. Never before have we had that much debt. Therefore, if the government raised the interest rates by 1%, the interest rates alone would be higher than Medicaid and Medicare. Okay, and so 2% higher, just 2% higher, the debt service alone would be higher than all defense spending. Imagine that, 2% higher, going from 0% where they are now to 2%. The debt service on a loan would be higher than all worldwide defense. It's a staggering sum. Therefore, raising the rates even by a little bit is going to create a massive problem, right? So I think the Fed is going to have a problem. If they actually ever acknowledge that inflation is really an issue and they actually wanted to fight it with interest rate hikes, they can't do it. How are they going to do it? Can't even service the debt. So I think there's a major problem with interest rates, which of course for us in the short term is good because interest rates are going to stay low. And this, by the way, is also one of the reasons that prices have been going higher, is because interest rates have been going lower. You just got to be honest about that. So obviously low interest rates means continued high prices, or at least the same prices. Now, the thing that could drive up prices is the next two factors, which is increased demand and rising inflation. So let's talk about increased demand first. First of all, for a variety of different reasons that we can argue about all day long, we've had soaring costs, particularly around construction material, wood, and things of that nature. And this really affects everything because this affects new home builds, right? We have this massive home shortage. We've had it for a long time, and builders have not been able to catch up at all. And now we have these skyrocketing costs, making the price of house so expensive for builders to be competitive, and then homeowners being able to afford it. So the last 12 months, the median house price went up from $286,000 to $326,000. And the housing shortage is worse than ever. Some experts I saw on Forbes will say it would take a decade of record construction to fix this problem, right? Skyrocketing steel, lumber costs, right? Just go online and look at this kind of stuff. And it's really driving up the house, not only driving up the houses, which is one thing, but the supply is simply not there. And this affects, of course, any kind of multifamily construction as well. And the truth is, the soaring construction costs means that there's a low supply of affordable housing. You weren't even able to build affordable housing before COVID. Okay, you can only really just build Class A housing, but it was already too expensive, and now it's almost impossible to create more affordable housing. Well, affordable housing therefore has a stagnant supply and an increasing number of people who want it, and so therefore we have an even bigger shortage in affordable housing than we've ever had before, and that's driving up demand. So we have this housing shortage going on right now. And the thing about the housing shortage is that it's not created equal. So there are it's not going up equally across the board in the country. Rents are increasing in some parts and some parts are not. For example, if you look at some of the population migration, from reading the headlines that people are fleeing to big cities like San Francisco and LA, or New York, and they're moving into Phoenix, Huntsville, Atlanta. If you look at all the population growth in those areas, that's exactly where it's going. If you look at the rent increases in those areas, rent is going down in areas like San Francisco and going up in areas like Boise. They're going down in New York City and going up in Huntsville, for example. So these population trends and these demand drivers are not created equally throughout the country. They are local or regional. So these housing shortages and this demand for affordable housing, coupled with COVID, where people can work from anywhere, is driving people in a migratory part, basically moving in a way that's never happened before in recent history. So that's number one. Number two, while this is going on, though, while there's a housing shortage and prices going up, incomes have been going higher, and they've been going higher ever since 2010. After we're knocked down the recession, they are now at their highest points ever in U.S. history. The incomes have been. And this has been accelerated by the COVID and the subsidies that we got. The average household got over $11,000 in money. We got increased employment benefits. People have more money than ever before. And that then means that they can pay more on housing. And therefore, houses are still being sold within a day. And that's also why rents are going up, which leads me to the next thing, which is we are in an inflationary environment right now. And you hear about this everywhere on the news. We just talked about some of the rising construction costs, but we see it in things like used car prices are going up, and you can blame it on the supply chain, yes, and I'm sure it was reduced a little bit, but it doesn't really explain why it's still here. And or why it would even be transitory or temporary, right? I mean, think about it. If you lock in a tenant at a certain higher rent, okay, once their 12-month lease is up, it's not going to go back down. That doesn't make any sense. They're used to paying that now, and they're used to paying whatever $10 a foot for wood. And once that's in place, they're not going to pay less. It just is what it is. The inflationary environment is higher than ever before, which is underneath all this. It's a symptom of the problem, which is people have more money to spend because of all this free money out there. So the inflation rate is right now, by all measures, around 5%. Though surprisingly, the Fed is still saying it's slightly higher than their target of 2.2. I don't know how they're saying that, since every measure is putting it somewhere between 5 and 6%. And by the time we're done this year, it'll probably be closer to 10%. But I'm okay with it, because here's what it means. A rising inflation means that incomes are going up. Okay. In fact, we're seeing this going up right now. We're getting rents, guys, right now that we haven't projected for year 4 and 5. And some of our properties, rents have gone up 10% year over year. And it's like, it's like trying, hey, let's just jump it by $50. We're 95 to 96% occupied. Let's see if we can get $50. Get $50 more, the $100 more, $100. There's so much competition for affordable housing of high quality that we're getting higher and higher rents. But let's say inflation kicks in, at higher than 5%, 10%, right? So incomes, the rents are now going up by whatever, 5 or 10%, whatever the case is. And your expenses, of course, are going up by the same exact amount. But since income, let's say it's 5%, okay, 5%, it's going up 5%, expenses are going up 5%. Well, your NOI over time is not going up by 5%. It's going to get higher and higher every single month this goes on. In other words, the NOI keeps getting bigger and bigger and bigger as the inflation stays the same. Therefore, if NOI goes up, as you know, the value of buildings goes up. Okay, and that's exactly what's happening right now. Basically, all these factors that are fueling inflation, putting more money in the system, increasing expenses, low supply, high demand, all these things are driving up the rents, and therefore driving up the prices of these buildings. Now, the question is, how can this possibly go on? Well, let's talk about it right now. We have interest rates. We talked about we're going to stay here for at least 2 to 3 years based on current guidance. And then again, I don't know what the Fed can do to materially increase those rents. I think the bigger risk is inflation. If the Fed can't raise interest rates to slow down inflation, it could get even higher. Well, that's okay. we're going to make more and more money with a rising inflation. The key is to get into now while it's still 5%. And it just started right now. So if inflation continues, what it appears like it is, then rents and prices are going to continue going up even higher, right? So, and then we have ongoing demand. There is nothing in the cards that's showing us that the supply is going to get increased in a meaningful way in the affordable housing and rental space. It's just not there. Therefore, we have continued high demand and no increase in supply whatsoever. So I add all this stuff together, high demand plus limited supply, rising incomes, and inflation, of course, means higher rents, coupled with ongoing low interest rates means that we're going to get higher prices in the foreseeable future. And the lesson I have for you guys right now, we had that lesson, if the fundamentals are strong, stick with a strategy. I think I just proved to you that the fundamentals have been strong through the last 2 recessions, and the fundamentals are pointing to higher prices. However, you do have to adjust your tactics as the market changes from month to month sometimes. So lesson number 3 is, I would invite you to consider, don't ask, should I get started? But ask instead, how can I get started? Okay, that's really the question. And that's a question I want you guys to talk about. So, and there comes a point where you got to stop, listening to another podcast episode or reading another book. You have to just invest in your education. And we want to be there for you. We have, my gosh, we've been doing this now for over 6 years, and we have helped so many people do their first deal and then quit their job that we've really dialed it in. And I like to think that we have something for everyone, regardless of where you are in your current state and your phase. We have something. If you've never done your deal before, we have something for you. If you've done a handful of deals and you want to raise more money, you want to really scale your capital raising. So just check us out at themichaelblank.com and click on products or programs. If you're an experienced syndicator, you're looking to scale, check out our Platform Builders program. It's platformbuilders.com. Show you how to basically 10x your capital raise. So, next step for you would be to invest in yourself, whatever that means for you. Hopefully you found that useful in looking in your own looking glass and see what's ahead of you. And hopefully you can use that to take action, whatever that means for you. All right. Talk to you guys next time.